Welcome everyone. As Amy's just said, this is the third work stream that's focusing on funding and financing. As we talked about on Tuesday, we were looking at solutions to resourcing the internal expense of managing the decarbonisation workflow, which was around how do we pay for the staff, the energy audit, the business case, the remote monitors if needed, and what was the best way to move that forward. Today, we're looking at financing, and what we're going to be looking at is how do we improve the economics to transitioning to sustainable energy solutions and financing the preferred solution. Okay, thanks, Amy. So more specifically, we'll be looking at the financing mechanism around PPAs and leasing agreements. We will also be looking at what options there are to improving the affordability and economics of sustainable energy solutions. And then we will be looking at some alternative financing options. And as always, at the end, we will be looking at what the concrete next steps are going forward. As Amy hinted at, this is just the beginning of the process. We're engaging with the GPA community in what are their needs, what do they want, and from that we will be putting out some really sort of concrete support activities. Okay, Amy, next up. So let's go straight into it. About paying for a PPA and lease agreement, just to take you all the way back to the kickoff meeting at the end of April. We were talking about, the need to move to power purchase agreements and lease agreements for all the benefits associated to the payment options in terms of you were moving from a capital expenditure, which is the existing model at the moment, where a agency or humanitarian organization receives a grant and buys the solar system or alternative renewable energy system. It requires a lot of money, and it's just a model that's not working because of the huge amounts of outlay that's needed and the size of the problem. So from changing from a capital expenditure to an operational expenditure with PPAs and lease agreements, what we're looking to do here is actually move the payments. What traditionally would be paid to your diesel provider or your electricity company would just be switched to an energy service company. So we're not looking for any more money in the system to actually pay for this. It's just that there's a different service provider. So we are looking for solutions that are at the same cost or lower than the existing cost of energy that you may or may not, you are paying a particular facility. Amy, next one, thanks. But it's all important to note that, there are many reasons for the need to switch from diesel to solar solutions, the ethical, climate change, the real big hitters that are sort of facing, the global population at the moment. But, when we come down to the dotting the I's and crossing the T's, we need to persuade someone to do that. And the internal justification within the UN is around money. We need to promote the financial advantage of the new system over the existing solution. And, we do talk about, at the same cost or below. And in some instances, at the same cost might not necessarily be enough to persuade our management to switch over. And equally, if it's a more expensive solution, it's unlikely to go ahead unless we have someone in the organization, especially when it's regionalized and sort of the authority is spread into country operations. They are focused on the financing of that particular emergency or humanitarian response. We need to justify this problem. But, Amy, next slide. So how do we go about improving the business case? So here we're looking at options. So for where we are at, the existing cost of energy, we can improve the costing, and also where we are above the cost of the existing solution. There are a number of opportunities that we can look at and take to reduce those monthly costs and make it more affordable. Obviously, there are trade-offs associated to that. And one way of doing that is actually extending the length of the power purchase agreement or the lease agreement. If we look at leasing a car, for instance, we all know that, if we want to lease a new car and we want to pay that off over 3 years, that's quite a high monthly payments. But if we extend that leasing period or that lease to own period over another couple of years, those monthly payments become more affordable. The trade-off being that you'd probably end up paying a little bit more in the long run. But in this case, if that monthly payment is still less than what we're paying for diesel, there is a clear justification in doing so. One of the second options that we could look at is providing a down payment to the system. And again, just taking the analogy of a car, if we want to buy it through sort of monthly payments, if we actually put a deposit or a down payment up front on the system, that obviously reduces the financing needs and the cost to the car company, and also reduces their risk. It's exactly the same when we're looking at energy service companies. That down payment would reduce the monthly costs, reduce the financing needs of the energy service company, and make it more affordable to the end user. One other option is, looking at the traditional model that we use at this moment in time, where we as the UN apply to a kind donor and look for a grant. We can purchase a system. Fantastic, great. But then we go into the same roles about owning, operating, and continuing the sustainability of that. But what if we actually took that cost and we used that as a down payment on 4 or 5 systems? So we're moving away from buying one to actually leasing 4 or 5. So we're actually increasing the impact of that, and it becomes more affordable, especially when we're targeting what we would call uneconomic solutions at this moment in time. And if you're in the conversation on Tuesday, we can focus on multi-occupancy compounds, shared premises. So we have more than one organization or agency in a compound, and it only requires one system. Obviously, the economies of scale in sharing those costs would be felt across all those organizations. I was trying to put a car analogy to this one, and I think the best I can come up with is, rather than all of us buying a car, let's invest in a bus. I think that's the closest thing I can get to in terms of providing an example of that. And one of the things we've all been looking at, and if you were part of the conversation last year in these similar workshops, is about portfolio management. If we actually offer more than one site in a complete package, the actual risk associated to that and the economies of scale improve. So, sorry, the risks are lowered, but the economies of scale are improved. So it makes it more affordable. So rather than going for one PPA, can we not go for 4 or 5 in a country? Can we not do more across a region? So, looking at those alternatives. And then we have what we're going to, thankfully, we have some specialist support from UNDP's energy finance team today, and they will be talking later in this presentation about integrating financial incentives into the projects. So they will be discussing the options of things like renewable energy credits and carbon offsetting. And just while I mentioned renewable energy credits, we also fortunate to have Energy Peace Partners who will be discussing their REC process and how that may impact the sort of financing of your program. Thanks, Amy. Now this one probably from a UN perspective looks a little bit difficult for us to manage. Can we help the energy service company source cheaper financing products? Looking at having them have financing around first loss, impact funding. Because if we can actually get them cheaper financing, that can be passed back to the energy purchaser. So it's something that we need to look at. And being, the UN in humanitarian settings, being humanitarian organizations, there are a lot of interest in, providing impact funding for this scenario. And, without naming names, we are constantly being asked to look at what projects are available by financiers that have this impact fund available and ready to go. So if we can put the energy service provider in touch with these service providers, these financial services providers, it's great. And again, you know, as you're aware from the work that we've been doing previously with Energy MRC and Shell, is, you know, looking at de-risking tools, you know, what guarantees and liquidity options that are there around the termination clause. Again, it's de-risking the solution for the energy service company and the financing that's involved. So with that, in terms of guarantees and liquidity, you'll be hearing more from us very shortly on that. And, you know, as you can see, there's 6 or 7 options there. You can pick and choose one, you can use them all. So that is, you know, some of the options that are available to us as we go forward. Amy, the next slide. So that's the sort of first presentation today with regards to that. So please, if anyone has any questions or any comments, do you feel that we've missed some potential options out that you might be aware of, or would like us to explore going forward, please, you know, raise your hand, drop a comment in the question. I'll give it a little bit of time. Amy, if you just go back up slides, just so that people can have a look at the options there. You know, has anyone got any specific questions around those? Any others? I can't see any hands raised. Okay. No, great. That's good. So thank you for that. And if you do think of anything, do put your comments and questions in the chat, and we will either, if we have time at the end, pick those up or do it afterwards. So thank you. Next slide. So as I mentioned, we have some very specialist support being provided by Camilla and Matteo from UNDP's energy finance teams, who would just like to sort of go through some potential options. They're not all there, but the ones that we feel could potentially play a big part in supporting some decarbonisation projects. So Camilla, Matteo, over to you. Thank you.
Thank you, Mark. I think I'll start because if you let us see the following slide, there are some options that I will present, and then others that Matteo will present. So we will both have the opportunity to chip in here. So I'm going to start by discussing crowdfunding. We're looking at the non-traditional financing mechanisms that renewable energy projects or sustainable energy projects can use to finance their capital expenditures and their operations. And crowdfunding is interesting because it would allow an energy project developer to approach potential funders directly. This would usually be done through an online platform where the energy project developer would post a campaign, a crowdfunding campaign, basically describing what the project is and what the target for raising funds is. And basically what funders would do is just respond to this outreach and contribute as much or as little as they wish towards the funding target. In this way, you can reach out to a number, like a really wide investor pool, and raise money from a large number of investors. Usually the amounts would be smaller or smallish, but you would be obtaining funds from a really large number of investors, which makes this solution not ideal, but let's say appropriate for funding small scale renewable energy projects, right? It's becoming increasingly popular because it was used, there's been some success with using this to finance renewable energy investments in Europe. So for those of you who will have, I mean, everyone will have the presentation, The link that I've included here, the more info link here, is to a booklet produced by the European Union, basically summarizing their experience and lessons learned with crowdfunding for renewable energy. So I hope that is useful. Another interesting thing here is that, for instance, in the energy access space, there's already companies that, while they go to traditional funders for, you know, loans to finance main investments, when they encounter along the way additional financing needs, for instance, working capital, they're increasingly using crowdfunding to get those additional resources that kind of come up along the way during project implementation. Before we move on, it's just that a recent development in this space, this crowdfunding space, is to use blockchain technology for crowdfunding. And just to, you know, the simple version of that is that instead of reaching out to a pool of investors, you're reaching out to a blockchain community, and instead of I mean, what you're promising them, you're selling cryptocurrency, right, in exchange for the money you're wanting to raise. So it's just a different way, technology based, innovative, to do crowdfunding. However, there's just like a disadvantage to that, is that blockchain and cryptocurrency are still kind of uncertain in terms of the regulations that either apply to them right now or could apply in the future as that activity becomes more regulated. So that's what I had to say about crowdfunding. And now I give the floor to Mateo, who can discuss the following two alternatives.
Thank you, Camila. Good morning, good afternoon, everyone. Mark and the colleagues of Unitar gave us the very challenging task of presenting a lot of complex financial mechanisms in a few minutes, but I hope we'll be able to summarize and synthesize, and of course we can discuss much more broadly in a further engagement. So the second instrument we would like to present is the renewable energy certificates. This is an instrument that is not so well known outside of the renewable energy market specialists. However, it still has, it has already become a fairly large market, and it's actually a very central mechanism of the renewable energy market in a few set of countries, and principally in the US, where the market this year is estimated to have reached approximately $6 billion US. So it's already fairly large. And there's two main markets trading renewable energy certificates: a mandatory market and a voluntary market. So in the US, the mandatory market is basically established by states which define renewable portfolio standards, so that certain companies are required, or certain industries are required, to source part of their energy through renewable sources. And the challenge there, and what the REX seeks to respond, is that those companies or industries are connected to the grid. However, they're not necessarily next to a renewable energy plant, or they can not necessarily enter into a direct contract with a renewable energy producer. As such, the REX allows them to purchase indirectly energy that is generated through a renewable energy plant, and there is a market that registers each kilowatt hour generated by the renewable energy, and that they can then be traded on the market to a consumer of renewable energy. So it's an indirect manner of purchasing electricity that is being generated by a renewable energy technology. The challenge to use the REX for the work of humanitarian agencies and energy access is that in general, the regs are currently limited to certain jurisdiction. So the states that establish the standard, or the surroundings of the corporation that is seeking to purchase those regs. However, there are initial efforts that are being done to allow projects of decentralized renewable energy generation outside of the jurisdiction of these markets to enter the renewable energy certificate standards. And we will have the opportunity to have a presentation from Energy Peace Partners, who I understand have a specific experience on that. And I also want to mention that there's a newly established task force that is actually looking at how to integrate into the REC standard the possibility of trading renewable energy certificates coming from decentralized source of energy in emerging markets. So there's an effort now being done, and interest from large corporate who are purchasing RECs to look at alternative market as well to purchase their source of renewable energy. I just want to mention that the price are still quite marginal. It's estimated that the voluntary REC price in the US has been at 0.70 cents the megawatt hour. So it's important to consider that for a solar plant or a renewable energy access project, this is very marginal. It's a very marginal stream of revenue. So you could use that to cover some increased cost of transitioning from diesel to solar, or to cover operational and maintenance costs. However, this will not finance your capex of your solar investment. No? So this is very important to consider. And this takes me to the third mechanism, the carbon offsets, which in a similar way to renewable energy certificates will be a marginal additional source of funding for energy access or decentralized renewable energy project. So the difference between the carbon offset and the renewable energy certificate is that the unit that you trade is linked to a carbon unit for the carbon offset, and for the RECs, it's linked to kilowatt hour or megawatt hour. So as you switch from a fossil fuel to a renewable source of energy, you have as an additional benefits reduction of emission of greenhouse gas emissions. And in that sense, you could potentially capitalize on that emission reduction through carbon offset program. Carbon offsets markets also differentiate between voluntary markets and compliance markets. As an example of a compliance market, you have the European trading scheme, which has been established for the Kyoto Protocol initially, that is still working, where countries set up caps of emissions and then distribute units of carbons to the main industry, and those industries can trade those units to offset their emission, and a certain amount of this emission reduction can also be purchased from projects outside of their jurisdiction. However, with the current climate change global regulation, the mandatory market is quite limited in terms of a possibility of selling carbon credits on this mandatory market. So the market that we have seen, which have been a bit more dynamic in the last few years, has been also the voluntary carbon market, where you can trade a carbon credit to some purchaser that voluntarily has set up some targets of emission reduction, of carbon offsetting. A market that was looking to become much bigger for voluntary carbon trading as well this year was the aviation market, where they had taken commitment at the end of last year to start offsetting the emissions of the aviation sector, which is outside of the scope of the mandatory market under the UN Framework Convention on Climate Change. So there was a lot of interest from carbon trader on this new player in the carbon market to start offsetting the emissions from the aviation. Unfortunately, this was before the COVID crisis. As you know, this has affected quite a bit the aviation sector. And right now, actually under the baseline that was established for the aviation sector, they will already reach their emission offsets targets by just the fact that they were being grounded and that so many flights have been canceled. No? So it's still also a very niche market. And the point I want to make that is important on the carbon offset programs important consideration for the humanitarian sector is that the transaction costs are quite high. You need to go through a validation and verification scheme because what you are selling is a tradable unit and something that becomes a commodity through a process of certification. And as such, it's a procedure that can be costly for small scale project. You can have the benefit of aggregate a lot of these projects to issue carbon credits, but even when you aggregate those projects, looking at the marginal additional revenue that this can brings to renewable energy process, it's still something that will be an addition, but again, not a replacement of additional source of funding to finance the capex of projects. Let's move to the next mechanism, Camila.
For sure. So social impact bonds. It's easy to confuse these with green bonds or other type of bonds, and the truth is they are referred to as bonds, but they are not bonds per se. Social impact bonds are more like a public-private partnership or a contract between impact investors and the government and the public sector. They are used to have impact investors provide upfront capital for public projects that are intended to deliver particular social and environmental benefits and outcomes, right? The interesting thing here is when the project is implemented, the impact investors only get repaid if it was successful, right? You only pay for success. If when the public sector implements this project and for some reason the project fails to deliver the intended social and environmental outcomes, then they don't repay let's say the loan. Because if you do have to repay the loan, it's successful, then there's a component of capital and interest that the government needs to pay back. So it would behave as a loan. The only different thing here is that in case of failure, there's no need to repay it. So it's similar to, I mean, it can be called payment for results. It can also be called payment for success. There's different ways to refer to it, but the basic idea is that it's an approach, it's a contract, and it involves impact investors and the government, which doesn't mean that the whole concept or idea could not be replicated to serve a different setting or purpose. For when you do have the presentation, the link that I've included is to a UNDP website, which I find to be very useful because it presents a different series of financing solutions for sustainable development. So some of the ones we have discussed here are going to be there as well, and some others are additional, so that can be interesting to check. Moving on to the next one. So this is results-based financing, and I think this is interesting because it provides a way to use grants and donor funding more effectively. The fundamental idea here is that instead of making a payment upfront, using grant funding, for instance, you make the delivery of the payment, you make the payment contingent to achieving a pre-agreed result, right? And this is basically what we're trying to do here with energy. Instead of making an upfront payment to buy solar equipment, we want to be able to pay for the results of having that equipment in place, which is, you know, the energy services. More than a financing instrument, this is an approach, and an approach that is intended or has its origin in trying to make grant funding aid resources more effective by paying for the results they are supposed to deliver, rather than for the assets needed to deliver those results. So I guess that would be it for grant funded results financing, and we can move on to the next one. Green revolving funds. Interesting. So not sure if there's going to be a presentation from UNHCR on their particular experience on revolving funds, but in any case, I'll be just brief, and perhaps they can expand on this later. The idea with the revolving funds, it's that they are an internal pool of resources. For instance, used by an education organization to make funding available for energy efficiency or renewable energy projects that can generate cost savings down the road. So this internal resources are pooled into a fund, and from the savings, this fund gets replenished. And that's the basic idea. Either the whole savings or a portion of the savings replenish this fund and ensure that there's availability of funding for more projects in the future that can generate similar value. But again, the keyword here is that this is internal. It does require the organization, whichever it is, to to renounce the full savings and just like reducing budget allocation for, in this case, energy expense, and allow those savings to be just like absorbed by the fund to keep using them for projects. And that is not always an easy proposition, but that's the way green revolving funds would work. And yes, thank you. Internal carbon tax. I think there's some similarities between those two, the word internal being the keyword here. The difference is that with internal carbon tax, an organization decides voluntarily to assign a cost to the carbon emissions it generates, and to make business units or the organization as a whole pay that tax, and then use those resources to fund projects. And so that's the way this becomes a financing mechanism. Some organizations are doing this in preparation and based on the expectation that at some point there will be regulation on this, and the market or the government regulation will impose such a carbon tax on them. So this is kind of, if it's gonna happen, let's do it voluntarily, let's experiment with it, and let's get used to it before. Just a figure, as of 2015, there were at least 435 major corporations, of course in the US and Canada and in big countries, that were already using some for internal carbon pricing and mobilizing resources through that tax to advance their investments in more sustainable energy. And the next, please. Energy savings performance contracts. So these are, of course, they're a contract, and the parties to this contract are an energy service provider, or an ESCO, as they are normally referred to. So an energy service company, and the client. They were by the United States government to work or to promote energy efficiency interventions in public buildings. And the idea here is that by ensuring that the energy service company will have a source of revenue, the government is, or the client, is therefore making it, making the ESCO's project bankable, and enabling this ESCO to go to the financial market or to whoever and seek financing, right? So it doesn't really solve the issue of financing in terms of providing the liquidity, but it does ensure or mitigate the risk associated with the company receiving revenues in the future, so that it's easy for this company to go to a bank with a bankable project and source the financing it needs. The way it works then is the ESCO will conduct a comprehensive energy audit or draw a comprehensive business case for the energy efficiency or renewable energy project, and source the financing it needs, undertake the investments, and only after commissioning equipment and delivering either the energy efficiency or renewable energy related services will it start to receive this payments based on performance. So other than that, I think that's what's most important about performance-based contracts for energy. And moving on, the last box, Mateo is going to present the last box, which is just grants outside of the traditional funding avenues that we can think of kind of immediately, and he'll expand on that.
Thank you, Camila. In terms of other grant mechanism, apart from the traditional funding routes for humanitarian agencies, I work more on the climate finance side. For me, those are the traditional finance resources, but I understand that for humanitarian, those are a bit different. So you have international climate finance funds, such as the Global Environment Facility and the Green Climate Fund, that can finance projects that have climate impacts and benefits. No? So we usually link energy access to climate benefit. However, this is still a topic in discussion to actually demonstrate the full climate finance impact of these energy access projects. The challenge for these climate and environmental fund is that their main objective are to be the most efficient in investing their resources in reducing greenhouse gas emissions. And in this case, if you look at the abatement cost and the efficiency of dollar invested per ton of CO2 in investing in energy access project, actually the efficiency is not as high as other alternative. And as such, we are still, as an energy community, building the case to promote more and additional investment from these alternative source of funding for energy access, such as climate finance resources. So there's an interesting movement that has been generated with the idea of publishing a flagship report to the COP that was going to take place this year and that has been postponed to next year, to demonstrate the potential climate impact of energy access investment and how energy access is actually a good investment alternative for these other sorts of funding. So I think we are currently in an interesting trends where the energy access market is getting better organized and becoming a more mature market, and where these actors are organizing to show the actual benefit in climate and environment benefit of investing in energy access. So I will stop here. And I think with that, we have covered the 9 mechanisms that we wanted to present briefly today. Thank you.
Thank you for providing probably a semester of financial instruments to us in half an hour. Thank you very much, Matteo and Camila. I'm taking over from Mark, and I have the pleasure to guide you through the rest of the session today. And before we go into the next session, I would like to open the floor to all of you to ask questions to Matteo and Camila. Some of them are already on the chat, and there is this question which came also up in earlier workshops around the ownership model. And Raphael posted this question: when we have an ownership model where the ownership stays with the private actors, to what extent can we actually use the RECs or the carbon credits in these settings to get some additional revenue? Could you explain this a little bit further?
Yes. So in this context, it's actually very important to include some clause in the legal arrangement with the energy service provider to define the ownership of these potential source of additional source of revenue that could be the RECs or the carbon credit. So there you could define whether this actually unit is transferred to the off-taker, which would be the humanitarian agency or the refugee camp, for example, or if the unit is owned to the energy service provider. So you have to define that in the legal arrangement, and then I think those units could be used as a mean as well to reduce a bit the cost of the service provider or the service contract, and or cover certain cost of operation and maintenance. Mm-hmm. It's important to know that if there's no legal arrangement on that, in general, the ownership of the unit is by the owner, is to the owner of the assets.
Sure. Yeah. And do you think, this is referring to Raphael's second part of the question, would it make sense if we have a centralized process, as we have, some of us have in mind, to outsource this whole project development to a central space? Can we include the whole offset and REC component from the outset into the central space?
I mean, I think this is something that will need to be assessed in more detail, but in principle, it's something that would make sense to also include in the leasing arrangement this transfer of these potential RECs to a centralized unit that then is entering into selling contracts to corporates that are interested in buying these certificates. And it could be actually an interesting way to finance this sort of centralized unit, because exactly. Again, it's a marginal additional investment, but that could be an interesting thing to assess. Yes.
Yeah. Yeah.
Again, this is a very incipient market to be able to purchase RECs from projects outside the jurisdiction of these certificates. No?
Exactly. And Marianne asked, what is the average price for a carbon credit at the moment?
Okay, so Marianne, I've just looked it up. I didn't knew it by heart, but for 2018, the average price was $3. But it's very important to note that as the voluntary market is a voluntary market, this price varies quite a bit. You could, I would say, to 10 cents to $200 the ton of CO2, because the purchaser of this unit is actually purchasing a story behind the unit as well. So certain purchaser will be available to pay a higher price for a project that have high development impacts, for example, and a much lower price to a project that is simply reducing greenhouse gas emission without other additional impacts. So there is a very high range, and this has to be negotiated for each case, as they're not a general market price for this unit.
Yeah, I can imagine Dave and Sherwin from Energy Peace Partners could also explain a bit further when they present, right? And final question from Irene. Oh, there's a new question already from Marion coming in, but another question from Irene. Have energy savings performance contracts been used to your experience? I know we tackled this in the last workshop already a little bit, but maybe you have also dealt with them already?
Well, yes. In the question is specifically in developing country context, and the truth is, a lot of the effort right now is focused on creating the ESCO ecosystem, in promoting and somehow helping ESCOs to be developed, right? So I wouldn't be able to speak. I mean, maybe Mateo has, but I wouldn't be able to speak to like a signature, successful, really good example of a energy efficiency project, for instance, that was implemented this way in developing countries. Other than pointing to the U.S. example as a way to describing the concept. But it's because at this point, a lot of effort from actors like the World Bank or, the multilateral development banks are focused on supporting the creation of the ESCO space. Mm-hmm. And so there's positive results and progress, but it's not like, this is the example for how this could be replicated.
Yeah.
Just to complement on that, I think indeed, in terms of energy saving and energy efficiency, this is yet an incipient market in developing countries. However, it's accelerating very much in looking at energy service performance contract, not on energy saving based, but on energy as a service. And in this, there is a lot of progress. And now you have an important market, for example, in sub-Saharan Africa, on energy service companies that are entering into energy service contract with consumers and households. And there you have the whole pay-go model that has been growing really fast, that links the use of energy assets to the digital platform of mobile payments. No, so I think you are now seeing the market switching to this payment based on savings to a payment for an energy service. And this is growing very fast in developing countries.
And for the benefit of all the others and those who haven't been on all of the workshops, we've discussed including energy saving performance components in the PPA and leasing model in workshop, I think it was 2.1, I think. So around the whole discussion on procurement and developing the long-term agreements, we already discussed this, how to include energy saving into the new systems, into the new business case. Final question from Marianne. Who covers the transaction costs, validation, verification in a third-party ownership model?
I mean, that will be the issuer of the credit, no? So in the case of a third-party ownership model, even if you have a legal arrangement where you will transfer the credit, I mean, you could define that, but in general, the one who covers the transaction cost has to be the one that issued the credit. But there's alternative arrangement that can be done on that. You also have cases where the purchaser of the future unit is willing to pay those transaction costs as well. So I think there's a lot of different arrangement that can be structured to cover those transaction costs, but in sort of a general principle, the issuer of the credit will cover the transaction costs unless something else is arranged.
Mm-hmm. Okay, thank you very much. I would suggest we leave it here because we have two more very interesting presentations ahead of us. And we talked about the revolving fund, and we are really pleased to have Irene with us today. She is the Senior Innovative Finance Officer of UNHCR since, Irene, correct me if I'm wrong, something like a year almost, right? Not yet. Okay, half a year. And she has a strong background also from the private sector, and we are really fortunate to have her on the call today. She will explain a little bit the ideas, at least from UNHCR, to develop their own revolving green fund. And Irene, the floor is yours.
Thank you, and thanks to everybody for the chance today to present what we're doing. And I should also say that it's really not me primarily working on this project. There's a whole team of us at UNHCR that's been working really hard on this, and some of whom are here today, but many others are not on this call. So it's been a really great team effort. And then the second thing is that it's a huge work in progress. And so what I'll talk about today is what we have gotten to so far. But I want to recognize that that we probably don't have it all right, and some things will change as we go along further. So if I could have the next slide. So I want to start with why it is that we are trying to work on this project, which we're calling the Green Fund Project. I won't belabor this because this group knows all too well the situation that many agencies like ours face, which is that we have a dual issue of producing more greenhouse emissions than we would like, or that we need to from an operational standpoint, because we have diesel-based power systems in many of our locations, particularly in sub-Saharan Africa. And it's a financial issue. So diesel is in some cases, not all of our sites, more expensive than solar. And the real sort of practical barrier to switching has been that, with our annual budgets, it's hard to have the upfront capital outlay to buy down these systems, particularly for our very large sites. And as a humanitarian agency working in very uncertain contexts, it's been hard for us to commit to the long-term contracts that the private sector would need in order to lower the monthly payments to be equivalent or slightly lower than what we pay today. So those have been the twin sort of practical barriers preventing us traditionally from switching to solar on a large scale. And so the model that we have sort of set ourselves to work on is setting up an internal revolving fund. It is internally held, but the seed capital has been provided from CEDA. And it's going to help us back contracts where we are able to enter into arrangements with the private sector for them to provide us clean energy as a service. The benefits to us are that it allows us to allocate the technical and the project risk to the private sector experts who specialize in this type of business, rather than trying to do the design and the engineering and the O&M ourselves. And it avoids, at least for a segment of our sites, the need for significant upfront capital outlays. And so, just to review, we're looking to try to generate carbon savings and financial savings. That figure would need to be validated, and we're trying to do the analysis on our first set of sites, but we're hoping that we can generate some financial savings in addition to the carbon impact. So next slide, the likely design, and again, this is all a work in progress, So in terms of the legal personality, this is not a separate fund outside of UNHCR. This is an internal fund or cost center within ourselves. Then the next item. So the uses. I think it's important to just recognize that our agency, and I'm sure many of yours, face a whole range of different size of sites in terms of energy demand. And so the first use that we're targeting is where there's essentially some of our strongest business cases, so really large staff compounds in off-grid locations or locations where the grid is highly unreliable, where we're currently running, imagine a 500 kW generator. And so those are quite large sites where they're suitable from a business case perspective for the PPA model. And so we're thinking that the fund can likely, the primary use would be to cover termination payments in the event of UNHCR's early withdrawal from the contract. And so we're imagining on the scale of 10-year contracts. And then the fund essentially sits there and gives comfort to the private sector that if we withdraw in year 8, they would get some portion of the remaining payments that would be due to them in years 8 to 10. And then some other uses for this revolving fund would be upfront subsidies. And so again, this would be for our smaller compounds in particular, where the economics would call for an upfront capex buy down, and of course the operations and investment and admin support to cover the upfront costs in order to design and issue a good tender. And then the sites, I alluded to this already, but we're prioritizing sites with high energy demand first. And early termination, I don't think I meant that. So we're prioritizing sites with high energy demand where the model is more about covering the potential termination risk rather than ones where we need substantial upfront subsidies. And then the UNDP colleagues already said, one of the strategies to try to improve the business case is to put forth a portfolio of sites, not just one by one. And so we're very much looking to bundle sites together in order to increase the attractiveness of the private sector to bid and to bid competitively on a total package. And that also helps us spread the risk of early termination from a financial standpoint, so that our eggs are not in just one basket where it's do or die. And if that one site terminates earlier, then it then means that we have to pay it out completely. And so, of course, then before moving on to the next slide, I'll just make the point that, because we're looking at sites with an inherent business case that's positive, the fund should be able to revolve. And so they'll back a certain number of contracts, ideally procured out in a bundle. And then the obligation is high at the very beginning when there's 10 years left on all of the contracts and all of the sites. But then as we move forward in time, assuming that we don't have too many sites terminating early, then the funding is freed up in order to back another round of sites to be tendered out. So next slide. Lessons learned so far. So 3 things. The first thing is that the site economics can vary really greatly. And we're learning this live, where actually our pre-feasibility study to this project looked at sites that turned out to be on the smaller end of the spectrum, and that drove the financial model one way quite strongly. And then when we added in a few of our other sites that are larger in energy demand, it completely changed the financial picture of the portfolio, and therefore the financial instruments that would need to be brought to bear. And so I think, with this project and this type of idea, the conceptual toolkit is actually fairly clear but the details really matter as to, and will drive which tools are most relevant to be used. And I encourage every agency to really find out for themselves the answer to that question in a data-driven way. The second lesson, it's been really critical for us to work cross-functionally and across headquarters and field. So I don't mean this in just a kumbaya way, but genuinely, you know, this project has for us touched a huge number of functions. And we've been lucky in that so many of our colleagues have dedicated their time to helping us think through what this model looks like. It hasn't been very easy, but it really is a cross-functional, cross-team, cross-field HQ efforts that would be required. And because so many people need to input, we found that strong project management capacity is really key to moving things forward. And then the last item is this need. We've been balancing ourselves, and I don't pretend that we've gotten it done perfectly, but to balance aspiration with practicality. And so for us, our portfolio of sites that currently run on diesel is really large. And then that's just looking at ourselves, much less looking at, you know, sister agencies who may be operating an office right next door or across the road, our INGO partners, and then of course our beneficiaries, refugees and host communities, which often lack clean energy access. It's been the kind of psychology of it to try to tackle as much of it as possible, to try to tackle as many of these things as possible, is definitely been present. And you know, there's also, I think, a possibility to just be paralyzed by the enormous need, or paralyzed by all the analysis you can do to try to segment exactly the smartest way that you can, you know, carve out to start. But at a certain point, we've also found that we need to just ring fence a portion of the problem that's discrete and just say, okay, yes, there is enormous need, but let's start with this thing. And it may not be the absolute most perfect, like best business case package that we could put together, but it is a viable set. And so let's start there and do something, and then have the funds reaccrue into the revolving fund, and then we'll get on to the next set. So that's all that I had. So I'll happy to take questions.
Thank you, Irene. I'd like to just provide a comment on two things that you just mentioned last. One is project management is key, and I can't agree more. And we've discussed this at length in the first workshop series with the 2 sessions. How to set up a project pipeline like this, what kind of resources you need, what kind of knowledge do you need in the organization, what kind of IT mechanisms you would need. So for all of you who would be interested in this topic, go back to the first 2 workshops and you can get some ideas at least. And the second point was complexity indeed. And you're absolutely right. I really like this approach. It is super complex, and we can identify and work on every single component of that, but we can also just start it at one point in one project, and that's really key. And that's part of the whole workshop series, to provide the colleagues with some answers to the questions they already have when thinking about the first project. I have 2 questions also, and taking the liberty as the moderator to ask this immediately. So you're saying you have PPAs in mind with 10 years. Did I understand correctly? Yeah, that was the idea. Okay, and how likely is an early termination?
To be honest, we're not entirely sure. And one of the things that we have to work out in the next few months is how to calculate that. But we are looking at least in the first instance, long-standing sites in protracted situations primarily. And again, this is also where the portfolio approach is really helpful, where you know, we can throw in a couple of sites that are a bit more uncertain if we're confident that the majority of them would be ones where we do expect to be there for the next decade.
Yeah, exactly. Then we have a couple of questions already in the chat from my colleague Jonathan, who covers the costs in case of termination payment. I understood that would be paid out of the revolving fund, right? This is the insurance which kicks in this moment in time. Yeah.
Yeah, exactly. And because it's not a separate legal personality, most likely that we're looking at, in the event that we, miscalculate or something really goes off the rails, all wars in the world stop and all refugees go home, and so we shut down our sites, then at the end of the day, because it's not a separate legal entity, UNHCR would have to backstop any further obligation beyond the size of the fund, since it's held internally.
Okay. Mm-hmm. And is there a duration with the fund?
Well, so it's essentially fairly linear if you think about it. Like, so the first set of tenders goes out, and then there's, we're going to maximize as much as possible, right? So that it's covering the full 10-year duration. And then when we go forward 1 year in time, then, a tenth of the funding is, virtually released, right? Because there's only 9 years left to cover. And so then it'll be up to us to say, okay, at what point is there a meaningful bundle that can be put together further for procurement? We may want to wait until year 5 when we have half of it freed up again, or we may decide, oh, like there's some really attractive sites that we could back even in the meantime.
Mm-hmm. Okay, where you can have a good idea about the risk of termination, right?
Yeah.
A question from Catherine around the amount, around the size of the fund. Do you work with the seed money you already got from CEDA, and do you want to attract some more, or how does it work?
Yeah, so at the moment, we have enough seed money from CEDA to make it interesting as a start. And so we think that we'll be able to back about half a dozen sites. And again, these are some of our largest off-grid locations. And so we want to get through that first tranche. But if it works out well, then we would imagine that we don't want to wait, 5 years in order to do the second tranche. And so in that case, we would have to fundraise. Okay.
A question from Stephen Gitonga from UNDP. Because of the complexity of managing revolving funds generally, sometimes this would require a specialized financial management unit institution within UNHCR. Do you have that? Is it you managing this? How does it work within the organization?
Yeah, this is something that we're working out now, but it's an important point and one that's driving us to try to keep it as simple as possible administratively, and to make sure that it's as aligned with our budgeting processes as possible. And actually having it kind of sitting as, just a pool of money to give comfort to the private sector. It's as simplistic as you can make it. But even so, I think we're still in the midst of verifying that it aligns with all of our processes, because we do want to minimize the need for complex management needs. That said, though, we do have the agreement with CEDA to hire some dedicated external capacity to help with this, and also to hire a project manager. So we're aware that this thing requires some dedicated capacity.
Yeah, exactly. William, UNICEF asked, could an internal tax on carbon provide additional seed funding on the revolving fund? Any ideas on this at UNICEF?
Oh, absolutely. I mean, I think it's, in theory, that would be a great way to do it. And I think for the sister agencies on this call, such as you, William, that have an internal tax, this is definitely something that could definitely capitalize something like this for you. We don't have that at UNHCR, and so we were very fortunate then that CEDA saw the opportunity and gave us the chance to try this by capitalizing it through a grant.
Okay, we have to wrap up, so I would like to take the last question from Catherine. Did you weigh this up against an insurance option, so an internal insurance option, instead of a capital reserve to ensure early termination? When you procure with private sector, you buy an insurance that would pay out against trigger of exit early termination?
I'd love to learn what you have in mind, because it sounds like you maybe have some models that you've seen. To our knowledge, there is no insurance that would fit our particular need, and where we'd have comfort that it would definitely pay out, because it's not just a force majeure situation. You know, we may be asked to downsize, we may be asked it, and I think we just weren't aware of any existing insurance options. But if there are, please let us know.
Catherine, on this note, we are also in the process of working on this guarantee mechanism, and part of this will be a liquidity or will be a liquidity option, and the other part will be an insurance option. And also the colleagues we are working with, they realized there's nothing like an insurance which we would need on the market right now, because partially because we don't have enough data, we don't know what the risks are, and also this, given that this is a whole new setup, providing renewable energy solutions in situations of displacement is fairly new, so it is difficult. Okay, wrapping up, there was the last question also from William, and maybe I would like to ask Irene to respond to this question, either in the chat box straight away or later on if it would take too long. Thanks, Irene. Thank you very much.
Thanks.
And now I'm handing over to Dave Muzersky. He is a long-standing friend, I would say, from the GPA, together with his colleague Sherwin. Both founded a project, an initiative called Energy Peace Partners, where they developed, from our perspective, a very innovative way on adding a fragile component on the renewable energy credit system, which we already heard from UNDP. But nobody can explain this better than Dave. Dave, floor is yours.
Thank you, Thomas. And it's a pleasure to be here and to connect with this community and have a chance to present on this. As mentioned, I work with a group called Energy Peace Partners. And as an organization, we bring together folks with background and expertise in peace building and conflict resolution, renewable energy development and finance, and climate security. And that's an intentional approach to try to bridge some of the gaps that we see in this sector, and take advantage of some of the opportunities and gains, specifically in the renewable energy sector. So to go on to the next slide, please. Amy, our idea is around supporting renewable energy in fragile states, and doing so in ways that can also serve as to help support peace building and local conflict resolution. And what we saw at a macro level, and this will not be a surprise to anyone on this call, is that the countries that tend to be at greatest risk of conflict also tend to be those most vulnerable to climate change and with the lowest levels of electrification. And so we identified 27 countries that fall into the sort of greatest areas of vulnerability using those three indicators. And they're on the map on the screen in front of you, plus Haiti, which is not included there. And we also realized that there's a tremendous boom happening in the renewable energy world, and that renewable energy actually represents the majority of climate finance around the world. But very little is reaching the developing world in general, and only a fraction is going to fragile states. And so when you look at where the humanitarian footprints are in this world and humanitarian crises, they tend to fall primarily and overwhelmingly in these fragile states. And yet the finance flows and investment behind this renewable energy boom is not reaching these places, as you all know. So our idea to help address this is, if you go to the next slide, is something called the Peace Renewable Energy Credit. And the Peace Renewable Energy Credit is a variation of a REC, or an Energy Attribute Certificate, which we heard a little bit about earlier, that is specifically designed to help support renewable energy projects in fragile states. And it's an additional way to monetize renewable energy from projects in these settings. And it helps create a market mechanism and a link between projects in these settings and functioning renewable energy markets. And so for actors like yourselves, for developers who have relatively few tools for supporting renewable energy projects, this provides an additional economic incentive and an additional way to finance projects or to extend projects. And I think the conversation so far today has been around how to finance projects from an operational perspective, but I think it's also important to think about this as a way to support projects. So from a donor perspective or an investor perspective, there are relatively few opportunities to support a renewable energy project, in a place like South Sudan or Yemen or DRC. We've talked about grants. If it's a private sector company, there could be equity investment or debt. Renewable energy certificates, PRECs, offer an additional way for an interested and supported actor to support part of that project. And as mentioned, we're trying to leverage the voluntary energy attribute certificate market, which is $1 billion+ market around the world. And PRECs offer an impact, a REC with impact. So it's a premium offering, it's a new offering from one of our target countries, from a new renewable energy project, and from a project that has community engagement and community benefit, what we call a social impact component. I guess let's move on to this slide. So I mentioned energy attribute certificates. That's the umbrella term for this mechanism, which is a sister mechanism to carbon credits. And so the thing to understand about EACs is that they represent the claim to renewable energy. So when in either a compliance market or a voluntary market, when a project sells RECs, when a buyer is buying RECs, what they're buying is the claim to that renewable energy. If a project sells the RECs from that project to a corporate, the corporate then is able to claim X megawatt hours of renewable energy for their own energy footprints. The market for EACs is primarily in North America and Europe. And the other countries on this map represent the initial global marketplace outside of North America and Europe, under the main international standard outside of those two geographies, which is called the IREC, the International REC Standard. And so the countries that have been highlighted here show where IREC architecture exists for either where there's been a domestic IREC mechanism and marketplace set up, or the IREC standard has authorized a country issuer. And what you see is that there's not very much overlap in our target countries. And so if you go on to the next slide, please. This then shows the 27 countries we identified as climate vulnerable, conflict vulnerable, energy poor. The 3 in orange were, until recently, the only 3 IREC approved issuing countries in sub-Saharan Africa. And in October, DRC was added as the 4th country in Africa and the first of our target countries. And we Energy Peace Partners were authorized by the International REC Standard as the country issuer for DRC. So that gave us the ability to issue PRECs from eligible projects in the DRC and create this market link to support renewable energy projects in the DRC. So if you go to the next slide, how do they work? A PREC or a REC, in this case a PREC, is tied to the generation of a megawatt hour. So 1 megawatt hour from a renewable source represents 1 PREC. As I mentioned, it's a standard IREC, but with this peace building co-benefit. So it's a project in one of our identified countries, fragile states. It's from a new renewable energy system. And it includes this community engagement and social impact component. You need, for RECs to come into existence in the international system, you need a third-party issuer outside of North America and Europe, where the architecture is already developed. So in the case of DRC, and hopefully in our additional target countries, we, EPP, serve as that issuer operating under the international IREC standard. And the market for this is really corporate buyers who are looking to meet sustainability goals or social responsibility goals, but don't have options, at least on the renewable energy side at the moment, for REC purchases in much of the world, including in fragile states and the places where many of you are working. And so the concept behind the REC, what we're trying to do is to develop two different models. One is a catalytic capital model where a project would be able to pre-sell the PRECs that will be generated from that project in order to help generate the CapEx to finance the project, and that's what we call catalytic capital. And the idea is to be able to pre-sell multi-year strips of PRECs in order to finance up to 10% of the CapEx. And the second is a community impact model. So in cases where the project is already financed, and we'll talk about one after this, use the sale of PRECs in order to generate an additional quote unquote community impact project. And I'll show you an example of that momentarily. So if you go to the next slide, this is our first PREC pilot project in the DRC. So the system is a new 1.3 megawatt mini grid in Goma that was developed by a Congolese developer called Nuru, and it was officially commissioned in October. And it's providing new electrification. So they're building out a mini grid in the Ndosho neighborhood of Goma, one of the poorest and most insecure neighborhoods in the city. And we were able to facilitate the pre-purchase of the first 1,000 PRECs from a large corporate buyer. So that's the first equivalent to the first 1,000 megawatt hours from this project. And the corporate purchaser, hasn't been made public yet. It was supposed to have been announced last month, but it's been delayed due to the COVID-19. So hopefully the announcement comes out soon. But the corporate purchaser was interested in this project because of the impact story, basically. It met with, they're a large REC buyer globally. They didn't have a significant presence in DRC, but they were attracted by the story and the impact of this REC project. And so with the opportunity for an additional revenue stream, the developer consulted with the community, identified nighttime lighting and nighttime insecurity as a top priority of the community. And so they were then able to fund the first phase of this of a streetlight project in this neighborhood where the mini grid is being built. So the PRECs sold at $45 each. So the first 1,000 brought $45,000 to Nuru. That enabled the purchase of and installation of 35 streetlights. Just to touch briefly on a few of the questions that had come up in the earlier section. The idea is that PRECs will sell at a premium. They do, I mean, in the US, they sell anywhere from 50 cents to $15. In the Europe, from under €1 up to 7 or 8 euros. But the idea is that there's a corporate trend around additionality and impact, and corporate buyers who are looking for projects that can be impactful, and that they're willing to pay more for projects that bring on new energy access and have other kinds of impact and co-benefits. And that's what we're trying to tap into with the PREC. So if you go to the next slide. So this shows where we're initially working. So DRC is our first country. That project in Goma is the first PREC issuing project. But we have other projects in our pipeline, both social impact projects, and we're trying to test the catalytic capital model where we're able to pre-sell PRECs to a corporate buyer or a government in order to help get projects financed. And then the next set of projects that we have lined up are in South Sudan, including the project which maybe has been discussed on on past calls in IOM's humanitarian hub in Malakal. And so that's a humanitarian setting. IOM manages the humanitarian hub. There are 30 plus NGOs and UN agencies that operate there. And it's a energy as a service model that the project has been developed by Cube Energy and Scotech Solar, and they own the energy attribute certificates. So the conversation that we've been having with the developers is, what could the additional revenue from the sale of PREC support in Malakal? And the community impact projects that we've identified with the developers would be the electrification of Malakal Teaching Hospital in town, and the lighting of health clinics in the IDP camp in Malakal. So that's an example maybe of a concrete application of PRECs on a humanitarian solar energy as a service project, and how, even though the project was already financed in this case, how it can still help extend the benefits there. So we're in discussion both with the developers and the IREC standard to hopefully be able to issue South Sudan as the next target country. And then we have conversations and potential projects in the pipeline in Mali, Chad, Uganda, Central African Republic, and Somalia, as well as DRC and South Sudan. Next slide, please. That was it. So I can stop there.
Thank you very much, Dave. That's really great. And also thanks for coming back also as an outlook, what you have in mind in the IOM compound in South Sudan. Indeed, we touched upon it in recent calls and recent workshops. We didn't go into details, so thank you very much.
Okay.
And I think as it was outlined by Matteo and Camilla from UNDP, to our understanding, the PREC or the REC in general could generate additional revenue, which could provide additional services to, for example, the persons of concern. Although we all acknowledge it's not a way to finance the whole system, right? It's really an extra benefit which we can earn in this process, and that's why we thought it would be very useful to hear the presentation today. And you made your point that you would say roughly 10% of the capex might be funded by the PREC. So really, thank you very much, Dave. I have got one question from Jonathan. In the GOMA project, which part is responsible for the collection of the money? What type of insurance is in place to address for overdue bills or default?
For the mini grid itself, or for the PRECs? Well, maybe for the mini grid itself, it's the company Nuru. They're a private sector company, so they have built and are extending the mini grid, and they are responsible for the financing and collection and sales and marketing of that. For the PRECs, the contract was between so we've been trying to work both on the supply side, if you will, which is conversations like these and developers working in these markets, as well as on the demand side, and trying to raise awareness among carbon trading companies, corporate buyers, that there are REC solutions and PRECs available in DRC and South Sudan, and a new impactful REC option. And so we worked on the GOMA project with a carbon trading company who was the intermediary with the corporate buyer. But the I don't know if that addresses the question directly, but it's the private sector company, and that tends to be our model, that we work with the developer as the local partner. It could be a UN agency, it could be a UN funded project, but I think it potentially fits nicely with what I heard the direction of the conversation so far today, which is looking at leveraging private sector projects, private sector partners to help provide energy solutions for humanitarian operations. And I think in that context, PRECs could could either help in either one of these models, either with the upfront financing through the catalytic capital model or with additional revenue that then extends the application of services. And it should be noted that through our engagement in that second model, the case where projects are already financed, we do require PREC developer partners to use a majority of PREC revenue for that social impact project.
Okay, thank you very much. Any other questions? Okay, seems not the case. Then we're going to go to the last section for today. We heard the 9 options as it were outlined by our colleagues from UNDP, and we would like to get in the final 10 minutes into a discussion with you. What do you think are the best financial solutions? Of course, we know it's a bit black and white, and the reality is somewhere in between, but we would like to ask this question in that sense. Amy, next slide, please. And we would like to get your opinion. Imagine we are rolling out these large-scale programs to replace diesel generator or diesel-powered infrastructure and using PPAs and leasing models. Which of the financial mechanisms that had been explained earlier would you think could become a prominent part of this program? And we have this poll prepared for you, and for those of you who were part of in the last call, you can see it now. We would like to ask you to provide your answer and submit it, and then we can briefly discuss the results. Okay, Amy, master of the process, where do we stand with the feedback?
Just give it maybe 20 more seconds. We're at maybe halfway.
Another reason why we are doing this exercise is not only because we want to discuss it with you. Part of the exercise is also we would like to get your opinion on what are the elements we need to explore further in the future, but I'll come back to this point. Amy, could you pull it up?
Yep. Give it 5 more seconds. If you haven't voted, please try to cast your poll. All right, close the poll. It's interesting to think about combining some of these. There you go, Thomas. Oh, yes, should be able to see the results.
I hope everybody can see it. For those who can't, maybe because you're logged in over the phone, the winner is a revolving fund with 32%, then an internal carbon tax with 23%, and then with each of them 14% renewable energy certificates or energy saving performance contracts. It's interesting, especially given that, as far as we know, there are only 2 agencies, WFP and UNHCR, who are working on or who already have an evolving fund, but there are more who have the internal carbon tax. So this seems to be the way to go within our UN family. Would anybody like to share their thoughts on the internal carbon tax?
Thomas. Happy to chip in. It's Catherine here from the ICRC.
Okay.
I didn't choose an internal carbon tax, although we are exploring it. I think the time it would take to capitalize and set up is probably the biggest sort of, you know, disadvantage for us in terms of being able to realize that for what we're trying to do here is trying to support our delegations to accelerate the transformation. So it's a bit more of a sort of timing issue there as to why we didn't, why I didn't go for that option. So the revolving fund was the one I sort of lumped for, and you know, capitalizing that up front, as Irene has explained, you know, in support of the kind of first tranche of transformation, sounds like a very sort of appealing option. And you know, to some extent as well, there's always sort of hybrids within this answer, because we would, you know, perhaps also think about tying some of the fund there to results. So yeah, that's it from our side. Thank you.
Yes, thank you. Agreed. It's again, there are probably many nuances between these various options, as we heard already before when Matteo and Camilla explained the various opportunities. Anybody else want to chip in, want to present their opinion? Okay, then I would say we go to the next question, which is, as you can imagine, for those of you who were part of the program on Tuesday, it's the opposite. What is the most inappropriate? What would you not choose in a large-scale diesel replacement program? Again, these are the options. Please choose and submit.
Give it a few more seconds. All right, if you haven't voted, please try to vote now. Close the poll soon. All right. There you go.
Okay, interesting. For those of you who don't see the results, crowdfunding is the, together with actually carbon offset programs, is the most inappropriate solution with 27% each. And then we have the social impact bonds with 18%. What makes crowdfunding so irrelevant for us or uninteresting? You say it in English? Yeah. Would anybody like to answer this or talk about why he or she has chosen crowdfunding?
Hi all, it's Maurizio from WFP. I think the crowdfunding, as I know it, is a little bit too uncertain on the results. So we can't really rely on some kind of funding, both in terms of amount, but also in terms of timeline. And this makes our project, which have very tight timelines, and you know, we have to play with the duration of leases, duration of time of a country director when a country director is a country director, etc. So crowdfunding, I don't see it very effective over.
Thanks, Maurizio. Timing is a good point. Actually, we scratched our head in the past around crowdfunding. On the one hand, I think there's a there could be a benefit because you actually have direct contact with your donor, with the crowd, and you can actually use this also for marketing purposes. You can tell a good and appealing story for the people that provide you the funding. On the other hand, I do see the point that it's a lot of work and it's quite an administrative burden as well. We at Unichar tested crowdfunding for a totally different topic, for an education topic. And I can honestly tell you it was a disaster. I could go into details, but not the point here. Yeah, it's certainly something which we would need to explore much further if we want to use this option.
Yeah, it is definitely something that could be maybe taken into consideration as a percentage. So let's leave, I don't know, 5% or 10%, whatever it is, to crowdfunding. But at the end of the day, we do have our own, let's say, money in order to go ahead and finish the project, and then whatever we got just shortens the return of investment, both over.
Yes, very good point. Or use crowdfunding for additional activities once we have the system installed, for example.
Yeah, exactly.
Yeah. Anybody wants to comment on the carbon offset program? Okay.
Hi, Oliver here. Yeah, I just think it's highly problematic for the UN to issue carbon offsets, which is done probably through UNFCCC, which is also a UN entity, and then potentially offset our own emissions through our own programs or projects that are carbon offset projects. So it basically would. It's kind of a cycle, right? Where we offer the project and fundraise through a carbon offset project, and then buy our own offsets and fund our own projects. So I see a huge conflict of interest here, and therefore I selected that one as the most inappropriate. Over.
Okay, that's a good point. Yeah, yeah. Thank you. Okay, colleagues, that brings me to the final slide, and I will share. Could you give me the access, Amy, to share my screen?
Should be able to.
Okay, hang on a second. Okay, I hope you can all see the slides. We went through this. I'd like to wrap up, and before I go to the next steps, I would like to come back to the first, actually, to our opening session, and also do a wrap up of the whole set of altogether 7 workshops. So the idea was this, right? How can we come from the left picture, the old crappy expensive and inefficient diesel generators, to something like on the right picture, to a solar system. This was the whole goal of this workshop series. And as you all know on this call, it is a very complex situation. We had altogether I was counting 16 hours of a highly intensive, I would almost say, training program prepared for all of you in the first part of the workshop. And these are the 3 workshops we were running. We discussed the steps to undertake these energy programs. What does it take to develop fundable, bankable energy projects with a leasing or PPA model? What kind of know-how do you need in the organizations? What kind of IT services and so on? In the second work stream, we were discussing what a request for proposal and long-term agreements could look like. So we had a deep dive into procurement and finance questions. And in the last work stream, we discussed today and on Tuesday funding and financing questions. The overarching goal was to discuss with all of you on how to set up a project pipeline to drive a global energy transition in displacement settings. How can we really come from small scale projects here and there into large scale global change? And I think we captured a huge territory of topics in these 16 hours. As our director always says, if it would have been easy, someone else would have done it already. And it is not easy, as we all know. But we are really happy about the outcome of these 3 work streams. We had between 35 and 40 people always on the call. Some of them have been listening to all of them. So really thank you, especially to those, to our core customers, I would say. And as a next steps, or what are the next steps? We will prepare a very short summary paper from all these workshops. And out of this summary paper, you will see a number of draft recommendations and priorities. We will discuss these with all of you. We will feedback this to you. And the next step would be then to discuss how to deliver the priorities, the identified priorities. And we will, again, rely on all of you to make this happen in the future. I think what already came out was we want to work on a joint project proposal. We would like to explore a centralized mechanism with UNDP, with GIZ, on a centralized workflow on these processes. And as a sort of sidetrack on this, as you know, we are already working on a global guarantee mechanism, which will entail 2 components. One is a immediate liquidity component to secure the liquidity for the companies in an unforeseeable event of termination, or at least temporary termination. And the second component will be an insurance package. And we are really happy to work on this with Energy MSC, and Douglas is on the call today. We will share also these results with you. The report will be finalized within the next couple of weeks, and this will be the baseline together with the leasing and the PPA model for hopefully a large-scale transformation in the next couple of years. We will discuss also with UNDP, GIZ, and all other UN entities on this call on how to go forward with the LTA process. We hope to have identified 20-30 companies who would enter into this LTA process by the beginning of next year. And yeah, I think by then we have a very good and progressive framework in place with the LTAs, with the guarantee mechanism, and with a workflow to achieve a large-scale transformation and really allow the UN to achieve their goals, which we all committed to in the United Nations Climate Action Plan. So this is the wrap up of the 6 workshops. I really like to thank Amy and Mark and Paul from the team working on this very hard, probably preparing these 16 hours of slides and training probably was 35, 40 hours of preparation. And but I also would like to thank all of you who participated in this workshop. And we also would like to get your honest feedback on this. Originally, as you know, it was planned as a 2-day workshop in Copenhagen, beginning of April. Due to the current situation, we had to change everything. It is now a 6 times 2 hour short workshop online that required a whole different setup. We also would like to seek from you whether this was appropriate, whether we should change something in the future. I think it's going to be the new normal for many of us in the next foreseeable future, and we have to adapt this, and we have to learn out of processes like this. So with that, I'd like to thank you all. And if there are any final comments, any AOBs, please speak up now. Raise your hand or put it in the chat. Otherwise, I'm happy to close on time.
Thank you.
Okay, thank you very much to all of you. Have a very good rest of the day and of the week.
Thanks.
Talk to you soon. Bye.
Bye. Thank you.
Thank you all. Bye-bye.
Here we are again.
What did you think of that one?
Let me stop the recording.